How's it going, everyone? Welcome back. If this is your first time here, my name is Edgar, and this channel is about personal finance, real estate investing, stock market investing, and personal development. So that is something you're interested in, make sure to subscribe. In today's video, we're going to be going over how to buy your first rental property and the things you need to know, like how much money do you need, what should you look for, how do you know if it's a good deal, and everything else that is important to make sure your first deal is a success. So let's start from the very beginning, and the first thing you need to do before you even begin the buying process is saving for the down payment. And because this happens before the buying process begins, this will be step 0. For the most part, whenever you are buying a property with the intention of renting it out, most lenders will require a down payment of at least 15 to 20%, which means that for every $100,000, you have to put down anywhere between $15,000 and $20,000. Now, you've probably heard of people saying you can get into a house with as little as 3.5% down using an FHA loan. And yes, that is true, but that only applies if you're going to use a house as your primary residence, because you cannot buy a house using an FHA loan and rent it out. Now, there is an exception to that, and the exception is that you can buy a house using an FHA loan, live in it for at least 1 year, then you can rent it out. But for the purpose of this video, we're going to assume that you do not intend on living in the property, so you will need at least 15 to 20% of the sales price for the down payment. Plus, you will also have closing costs, so that can be another 2%. And if you're buying a property that needs work, even if it's simple things like paint, carpet, and landscape, you will also have to consider that cost. The exact amount of money you will need to begin investing in real estate will be based on the purchase price of the property, the cost of closing, and the cost of any repairs. Plus, whenever you are investing in real estate, it's always a good idea to have more money than you think you will need, because something always comes up, and when that happens, it's nice to have a buffer. So once you have enough savings, you can move on to step number 2, which is meeting with a lender, unless you are buying in cash, and if that's the case, then you can skip this step. The reason you want to meet with a lender before you even start looking at houses is you want to make sure you qualify for the price range you're looking at. I've had many clients who want to begin looking at houses first, and then once they find a property, then that's when they want to get qualified. But the issue is when you start shopping for real estate without having a pre-qualification, you cannot make any offers because the sellers and the seller's agent want to make sure you qualify for that property. And this can mean you miss out on a great opportunity because by the time you gather your paperwork and get pre-qualified, someone else has made an offer. Then other times you could begin looking at properties in a certain price range and then discover you don't qualify for something that high. So now everything else that you look at is going to seem less attractive, which is going to make the process that much more difficult. Now when you meet with a lender, there are a few things that they will look at, like your credit history, income, employment, and current assets. So before you meet with the lender, you should work on getting your credit score as high as possible, and ideally you want a credit score above 740 because this is when you will begin to see better rates from lenders. But if you want the best rates and offers, you should aim for 800 and above. Now, if your credit score is below 740, it does not mean you will not qualify for a loan, but it does mean you will most likely end up with a higher interest rate, which isn't the end of the world because you could always refinance. But you should try to increase your score as much as possible, and if you want some advice on how to do that, I will link a video where I discuss these steps to getting an 800 credit score. The next major thing the lender will look at is your income, and they will typically look at the past 2 years of tax returns. Now, if you're self-employed like me, then you want to be careful when it comes to your write-offs, because if you write off too much, then your net income is going to appear low. So if you're making $100,000 but you're writing off $80,000, then good luck qualifying for anything. Something else to mention is the lender will take the average number between the 2 years of tax returns. So if during 2018 you reported $100,000 in income, and then for 2019 you reported $150,000, then the lender will take the average between those two numbers, so they will qualify you based on $125,000. So if you're self-employed, you want to limit the amount of write-offs you take for the 2 years previous to buying the property. And even though this means you will end up paying more in taxes, this would be the only way to qualify for a property. Now, if you're not self-employed, then this wouldn't be an issue because the amount of deductions an employee can take is less than someone who is self-employed. So once the lender has all your paperwork and information, they will give you a pre-qualification stating how much you qualify for. But something important to mention is you want to make sure nothing changes between the time you get pre-qualified and the time you close on the property. Because if you go and buy a new car or you change jobs, it can mean you no longer qualify because your debt is too high, or it can delay the process because the lender has to verify all the new information. So now that you have your pre-qualification comes the fun part, and that is looking for properties. But before you spend too much time looking at houses, you should have an idea of what you're looking for, like what area you're looking to buy in, how big of a house you're going to get, and are you going to get a property that needs a lot of work, or a property that only needs cosmetic repairs, and are you looking to buy a single family house, a duplex, a triplex, or a fourplex. Now this video is about buying your first rental property, so you're most likely going to be buying one of these types of properties because once you go over 4 units, you start to get into different types of financing, which can get complicated for your first deal. Ideally, you want to find a property that has all the major items in good working condition, which are things like the roof, foundation, plumbing, and electrical, because when you start messing with these things, the cost can get out of control very quickly. So instead, you should look for properties that have good bones and only need a facelift. Maybe it has pink bathrooms, an old kitchen, or there's a jungle growing in the backyard. And the reason you want to find a property like this is because those upgrades are normally easy to do and shouldn't cost a whole lot of money, but they can really increase the value of the property and increase the amount of rent you can get. And when you're just getting started, you really want to stay away from major renovations because that increases the odds of something going wrong. And if you end up losing money, that can make it more difficult to do more deals in the future. Also, you should not settle for a property that is in a bad location, whether that means the property is next to a freeway or in a bad neighborhood, because when it comes time to sell the property, there will be less resale value and you probably won't be able to maximize the amount of rent you can get. So once you have this down, you should look at everything that fits within that criteria. And the more properties you see, the better, because then you will be able to compare them and see which are in better condition, which have more upgrades, which have the potential for increasing their value, and you will be able to understand why each property is priced the way it is. So now let's say you find a property that fits your criteria. Now comes the time to make some calculations and see if the numbers work. You should keep in mind though that a huge number of properties will not cash flow, so don't get frustrated when you look at 5 different houses and the numbers don't make sense. You just have to keep looking for that one that will cash flow or at the very least break even. So let's say you find a $500,000 house and you're putting down 20% or $100,000, and then you get an interest rate of 3.5%. This means that your mortgage payment will be about $1,800 per month, and this is assuming you go with a 30-year loan. Then we also have to consider property tax, insurance, repairs, maintenance, and vacancy. Here in California, the property tax is about 1.25%, so that means you will be paying about $520 per month in property taxes. Next is insurance, and depending on the type of property you're buying and where it is located, this can be different for everyone, but for this example, we will say it's $150 per month. Then there's repairs and maintenance, and this can include anything from minor things like fixing leaking faucets to major items like replacing the roof, and you can also include things like pest control and yard maintenance. So we will say this will be about $150 per month. And then we have vacancy, and this can also vary depending on where the property is located. If you're somewhere that has high demand for rentals, then your vacancy could be close to zero, because whenever someone moves out, you could rent out the property right away, and therefore you don't lose any money to vacancy. Or on the other hand, the house could be someplace where the rental market isn't so hot, so whenever a property becomes vacant, it can take you some time to rent it back out. So how much you set aside for vacancy will vary, but for this example, we will go with $100 per month. So that brings the total monthly cost of this property to about $2,700 per month. And once you have this number, you have to find out how much you can get in rent. And for this, you can go on websites like Zillow, Trulia, and Redfin and see how much similar properties are renting for. So let's say a property like the one in this example is renting for $3,000. That means you will have a positive cash flow of $300, and now we can calculate the cash on cash return. And for this calculation, you simply take the annual cash flow, which in this case is $3,600, and then you divide that by the total cash invested, which in this case was the $100,000 for the down payment. So your cash on cash return is 3.6%. But on top of that, the tenant is also paying down your mortgage, and in the first year, you're getting about $5,700 in equity. So that brings the total return of owning this property in the first year to $9,300. So once you find a property that has the potential to become a great rental and all the numbers make sense, then you can move on to the purchase process, and this begins with making offers. It is very important that you find yourself a good real estate agent because that can make all the difference in the world. A good agent will help you write strong offers that highlight all the benefits the seller will receive if they accept your offer. But at the same time, they will write the offer to make sure you get everything you want and need to make the deal work. But a bad agent can cause you to lose out on great deals because they are making mistakes when they are writing the offer, or they don't respond to you until the next day, so the process becomes 10 times more difficult. So just make sure your agent is working in your best interest and they know what they are doing. And a good way to find a good agent is through word of mouth. Maybe a family member or a close friend recently bought or sold a house, so ask them if they could connect you with their agent as long as they had a good experience. So once you get your offer accepted, the next thing to do are your inspections, and normally one of the first inspections you would get is a general inspection. And during this inspection, the inspector will look over everything from the kitchen appliances to the roof and everything in between. Then once that is complete, you will get a report that has everything the inspector found. And you should always expect that they will find something because no house is 100% perfect. So once you have this report, you can look it over and you will most likely find sections where the general inspector recommends that you consult with a contractor for a more detailed report. For example, it could be the house is sitting on a hill and there are signs that it could be shifting. So the general inspector points that out, but because he's not a full-on foundation contractor, he cannot give you a detailed report on what the problem is or how serious it could be. And this applies to anything within the house, not just the foundation. So once you complete all of your inspections, you can put together a list of the repairs you would like the seller to complete. or you can have the seller give you a credit and you can do the repairs yourself. Also, during this time, you will be receiving several disclosures from the sellers, the lender, and the escrow company. And depending on where you live, these can vary, so I will not go into detail on these, but just know they are coming. The next step comes after you close escrow on your property, and that is to begin any renovations. When it comes to this step, it is very important you find good contractors, and a good place to start is online. And you can read reviews and select the top 3 and have them come out to your property and give you estimates on how much the work is going to cost. Whenever you are meeting with contractors, it is very important you ask a lot of questions and get their opinion on things, and this will really help you decide who is the best fit for the job. Also, something to keep in mind is whenever you are doing any kind of work on a property, there will always be things that come up that you were not expecting, and this will cause you to go over budget and the work will take longer than you expected, so always have a buffer in your budget and timeline. Then when it comes time to deciding what type of materials and finishes to use, you should stay away from super high-end finishes, because the last thing you want to do is spend thousands on some nice hardwood floor and have them get damaged. You should also stay away from cheap finishes like carpet, because carpet doesn't last very long, so you could end up replacing the carpet every time a tenant moves out, and even though carpet is cheaper in the short term, it can cost you more over time. Ideally, you want to use materials that will last a very long time yet still look good. So things like scratch resistant laminate floor, tile floor in the kitchen and bathrooms, and maybe some granite countertops in the kitchen. These materials will make the property look nice and help you rent it out for top dollar. So once you're done fixing up the property, now comes time to renting it out, and if you want to rent it out as soon as possible and for top dollar, you need to make sure the property is ready to show. So that means all the construction has been completed and the property is clean. Then you want to list it for rent on as many websites as you can, and that can be Zillow, Trulia, and even Facebook. The point is to maximize the number of people who see the listing, so you have several options when it comes time to picking a tenant. Then when deciding what tenant you will rent your property to, you should have your own guidelines and stick to them. This can mean you only rent to people with a credit score of 720 and above, or their income must be at least 3 times what they are paying in rent. And when you do this, you limit the odds of having a bad tenant. So with that being said, these are the basic steps you will need to take when looking to get into your first rental property. And because this is your first time buying an investment property, there will be a learning curve. So if you make any mistakes during this process, just take it as a learning experience and make sure you don't repeat those mistakes. And from then on, it's just a matter of repeating the process and scaling up until you get to where you want to be. So with that being said, if you enjoyed this video or you found any of this information helpful, don't forget to drop a like and subscribe. Thanks for watching, and I'll see you next time.